Successful in life are unsuccessful because they cannot think long term. They can't plan their career long term. They can't plan their business long term. They can't even prioritize their health. If you see somebody who is morbidly obese, out of shape, and they're in their 20s, 30s, 40s, that is somebody who has not got any kind of long-term approach to their own life, to their own body, to their own health. If you see somebody who is constantly jumping from job to job, or somebody who is constantly starting and failing businesses, they probably have a very, very high time preference, which leads to impulsive decisions. If it's in the market, it leads to them over leveraging or trying to chase quick pumps, revenge trading, or spending their money instead of investing their money. Big part two. It's somebody who needs to buy some, let's take something, for example, like a car. If you have 50 grand and you're young and you want to have a really nice car, you might go and spend 20 or 30 grand of that on a car, which is a depreciating asset and provides absolutely no value to you long term, because you could buy a car for 5 grand that is the exact same. It's got 4 wheels and a roof and a fucking engine, and it gets you from A to B. And instead of using the very short-term mindset where you're wanting to get this thing now, to get the gratification, to get the dopamine hit, you're choosing instead to focus on the longer term and to invest that money. This is not the same as being tight or being stingy or being thrifty or whatever. People say is like, oh, you don't want to become a miserable person who never spends money. You want to become somebody who actually thinks about what they're doing when they're spending. Think of everything in terms of the return on investment. You can spend money if it improves your life. You can spend money if it's on experiences that add to your overall experience of this life that we have, this short life we get on Earth. Or you can decide to spend it on bullshit like fucking designer trainers whenever you don't have enough money to be able to afford that, or on this car you don't need, or on some, third holiday for the year that you don't really need, or whatever. And it doesn't mean you penny pinch and save all that money and put it under your mattress. It means you think about, how can I invest this? How can I buy assets? Because there's one thing that's for sure, and that's that all of our purchasing power is getting eroded in fiat. The governments, central banks, they are printing money. So we all know this. They are printing your euros, your pounds, your dollars, your yen, and they are making inflation of the money supply, which is meaning that if you keep your savings in cash, every year they are getting slightly less valuable. You get less stuff for your money. Okay, this is basic. We all know this. And yet most people don't buy fucking assets. Because the only way to get out of this loop, and this is the matrix, is to own assets. Okay? So, why has it been so successful for people like boomers and Gen X and people in the last 40 years, 50 years to buy and hold the S&P, for example? Because it goes up on average about 9% per year, compounded. Which means if you bought it 30 years ago and you kept topping it up every month from your salary, you could turn a 5-figure sum into 7 figures or even maybe beyond that. Because as you add to it and as it compounds, and because the stock market always goes up, it doesn't mean it goes up every single year, but you smooth that out over time, you end up with a lot more money than you began with. And if you take one person who was, 2 people who are 60, one of whom was back when they were 30, decided to focus on accumulating assets for the long term, and the other one who didn't, who decided to save cash, the person who accumulated assets has exponentially more wealth now than the person who didn't. This is you right now. If you're 15, if you're 25, if you're 35, it does not matter. You have to think about, in 10 years from now, am I going to be in the same position or am I going to be ahead? The people who are going to be ahead are the ones who are going to own assets. There's no other way to do it. The only other way to do it would be to assume that the market is somehow, and all the governments and central banks are somehow going to stop printing all this money and somehow make the worthless paper fiat valuable again. So I think it's pretty safe to say that's not going to happen. So you should be focusing on buying assets and holding them for the long term. Now, you don't have to do the Warren Buffett. You don't have to buy the S&P. You can choose the higher risk, higher reward alternative, which is Bitcoin. So And also, it doesn't mean you have to go into a fully low time preference mindset where you're only thinking about the 40-year plan or the 30-year plan. You can have a hybrid. And that's what tomorrow's lesson is going to be about playing the market cycles. You can absolutely look at how can I maximize the next 6 or 12 months of this bull market while also not taking my eye off the ball with the long term. It's a hybrid approach. Most people who lose in crypto take their eye off the ball completely for the long term, and they sell all their Bitcoin to chase into NFTs or altcoins or meme coins or whatever, and then they don't get out and they end up losing all of that or most of that and ending up afterwards with less Bitcoin or no Bitcoin and no long-term asset accumulation. So, Bitcoin's compound annual growth rate since 2014 has been 60% per year. That's insane. 60% annualized. If you add that up, and you can see this now from, where is my calculator? If you put into Bitcoin 10 years ago, 10K at 60% annualized, you would now have $1 million. Without ever putting another dollar in, if you just put 10K in and just left it, you'd have $1 million, right? With just a 60% annualized return. That's what Bitcoin has done over the past 10 years. That's doing nothing. That's just letting it sit and letting it compound, obviously, over the years. Now, imagine 30%. This is sort of the expectation that most people seem to have for Bitcoin, that it's obviously going to drop because at the start, in the first few years of Bitcoin's existence, it was compounding at a rate of about 200 or 250%. And over the last 10 years, that's dropped to about 60%. And over the next 10 years, it will probably drop again. But it's not going to drop as low as the S&P. So it's not going to go to 9% because Bitcoin is much smaller. It is much more volatile. There is still more risk to it. So you can be sure that the returns, assuming that Bitcoin continues to go up, and that is the assumption of all of this, but if you're in crypto and you understand Bitcoin, you'll know that that's a good bet to make. Then you're going to assume that it's going to compound at a rate that is much higher than the S&P because you're taking on more risk. And older people and wealthier people are not going to be as aggressive with their allocation. They're going to stick to the S&P. You, as somebody who is younger or who has a smaller balance or who can take on more risk, are willing and able to take that higher risk of the riskier assets such as Bitcoin. Now, to you, it might not seem like Bitcoin's even risky because you're comparing Bitcoin to like meme coins. But to somebody in the traditional finance world, Bitcoin is like the far end of risk compared to the S&P or compared to bonds, right? So if you imagine 30%, let's just say it drops in half for the next 10 years. If you had 10 grand and you put that into it for the next 10 years and you did nothing, it would grow to 137. Okay? So over a 10-year period, that would more than 10x just with that, just by putting it in, not touching it. And that would be in line with many of these predictions. Okay, so the only time I think that it's good to look at predictions of price is when you're trying to think very long term and you're trying to essentially bullishly brainwash yourself into a long-term approach, into a low time preference, into buying and holding for the long term, compounding and letting your portfolio and your wealth grow. The time you should not get overexcited about price targets is in the short term, where it's like, okay, let's get in and let's get 100x on this coin in the next fucking 6 months. And I want target is 10 billion on this meme coin. That kind of stuff is really very hyper speculative. If you're looking at BTC and you're looking at a 10-year time frame, you're looking at it from a perspective of where could it go by 2034? And if you think, 2034 is so far away, I'm going to be an old man by then, I want to get rich now. Yes, you're making the crucial mistake right away. You're displaying a high time preference. You are not displaying a willingness to have delayed gratification. And so, in 10 years' time, based on the power law, and these are just, I've picked out a bunch of random models, none of them are going to work. They're all just rough ideas, rough guesses. And the power law would say Bitcoin is going to be between 400 and 3 million, roughly, in 10 years, right? So 400k to 3 million, with a midpoint of about 1 million, 1.1 million. Yeah? That midpoint, that 1.1 million, would be almost exactly in line with 30% annualized, because it would be just over a 10x, right? So just over a 10x from here, 90k to 1.1 million would be about 11 or 12x. If you look at Rainbow chart, which is another one, if you go to 2034, that has Bitcoin anywhere between 900k and 3 million, right? Based on the bands. If you look at, I think there's 3 predictions here. If you go to 2034, looking at stock to flow, which I don't believe in whatsoever, but that's 42 million. Stock to income, 8 million. Power law, 1.3. HPR Rainbow, 1 million. And if you got the big G himself, Michael Saylor, his price forecast, insane, but this is 2045, so that's actually 20 years away. But his bear case is 3 million. His base case is 13 million. His bull case is 49 million per Bitcoin. So there's some super long-term, high time frame, crazily bullish predictions. And it's funny because people will look at this and they will laugh, right? So people will see these things and they'll say, that's so stupid. Bitcoin's not going to go to 1 million. This is that fucking dumb. Oh my God, Michael Saylor, he's going crazy. He's going to be the richest man in the world if that happens. That couldn't happen. What do you mean there's going to be $100 trillion market cap of Bitcoin? That's insane. And then they'll turn around with a straight face and tell you that, Pepe is going to $100 billion market cap, or it's going to $500 billion market cap, or that insert whatever shitcoin is going to go 500x from here. It's far more likely that Bitcoin's going to $1 million in the next 10 years than any of these, meme coins are going to go to 100 billion, 200 billion, 500 billion in the next year. You have to understand, what are people actually positioning for? If the game long term is that the rich get richer, yeah, if you think that the wealth divide is going to increase, as it has been increasing every year of all of our lives, if you think that that's going to continue to increase, how do you think it's most likely going to increase? Do you think it's going to increase because meme coins all go 100 to 500x in the next year and make all the poor people rich and they all get to stay rich? Or do you think that over the next 10 years, the asset that they all don't own, which is Bitcoin, actually does go to the $1 million target that they're all laughing at right now? It's far more likely that the latter happens. You can laugh at the idea of that happening to Bitcoin, or you can look at who would actually be positioned to benefit from that. If that were to happen, who would actually benefit? I'll tell you who wouldn't benefit. It's people with a high time preference. People who do not have patience. People who do not think long term. Because even if you owned it now, there's loads of people who own Bitcoin now and they bought it at 50k and it's now at 90 and it could even go to 200 and then it drops to 100 and guess what? They would sell it then in the next bear market at 100 and they would miss the run from 100 to 1 million because they're still not thinking long term. They might only be thinking of the next 2 years. And this happens every single time. This happened in the last bear market. When Bitcoin went from 69 to 15, people said that's it. It's done. It should not have went below 20, right? Bitcoin never goes below its previous cycle highs, which was 20k. Bitcoin has broken all the structure. It's broken the stock to flow. It's broken its logarithmic regression or linear or whatever. It's broken all these models. It's done. And the market gave up on Bitcoin yet again, like it always does, just because they have a high time preference, because they can't wait. They can't sit out and not, make a bad decision, essentially. And they prioritize what's going to happen in the next 6 or 12 months and completely forget about what's going to happen in the next 6 to 10 years. So you have to ingrain that into your brain first of all and understand that. So even if you did absolutely nothing else, you could turn 10k into 137 in the next 10 years. Now you might think, okay, well, I've got 10k. I don't want to wait 10 years to have 130k. That's fair, right? 10 years is a long time. 130k is not a lot of money, over a 10-year period. However, you're not just going to do this. First of all, you're here to learn how to trade, yeah? So you're going to learn how to outperform this basic assumption. And number 2, you are going to be earning and adding to it. So take the idea of the person who invests into the S&P for the last, 20 years. Somebody who invested in the S&P 500 for, let's do 10 years, same thing, with 9% annualized, you might do that basic calculation and think, oh, so somebody who invested in the S&P 500 in 2014 would have now turned their 10k into 23k. And you'd be like, that's not great, right? But that's not how people do it. They also put in a portion of their earnings out of their salary or their income every month. So you can dollar cost average or, just buy in at a regular schedule. So if you also deposit, and this is what people would do with the S&P, let's say you put in your initial 10K and you put in 500 a month from your salary, and it goes in monthly, every month, and each year you increase that by, let's call it 20%, because of course, over the next 10 years, do you think your earnings, your income is going to go up? Of course it is. So if you're able to put an extra 500 in each month, then the year after that, you should be able to put in 600 a month. The year after that, you should be able to put in 750, right? So roughly, let's say you put in 20% more per month each individual year as it goes along. That makes a big difference. So this is the S&P example. Instead of 10K turning into 23, 10K turns into 240 just by you also having a disciplined percentage of your income that goes into it as well. If you're always thinking of putting something in for the long term, it's going to take care of itself. The compounding is going to take care of it. And it doesn't matter if you're starting with 1K, 10K, 100K. It doesn't matter if you're putting in $100 a month, $500 a month, $1,000 a month. It doesn't matter. The main thing is that you should always be doing it. Because you're not doing it for right now, you're doing it for the future. And this does not mean you can't play the short term. Sorry about that. This doesn't mean you can't play the shorter term rotations. It doesn't mean that you can't have a bull market or buy meme coins or trade these things. You can do all of that. But it's about percentage of your portfolio. There should be some percentage that is doing this, and there should be some percentage of your income that is going into this. And you can choose any asset you want. Some people choose stocks, some people choose crypto, some people choose real estate, whatever. But let's assume you're going to do it through crypto because you understand crypto and you understand, Bitcoin and the value proposition and all of that. So you can see the magic of compounding here. And it's very simple. Compounding is super simple, but people don't do it because it takes time. And because it takes time, they prioritize short-term gains instead of long-term, and they end up chasing something for the next week or month or 6 months instead of thinking long-term. And here's the secret. You can do both. You can put 80% of your money into Bitcoin following this exact plan and 80% of your monthly excess income, right? So let's say you make 3K a month and you've got $1,000 spare each month. You make 3K, you live off 2K, you've got 1K, right? Just making numbers up. You can put 80% of that excess into Bitcoin and you can play the other 20% as trading. You can play the other 20% in meme coins, in higher risk, higher reward things. You can take the 80% of your current money, let's say you got 10 grand, you put 8 of it into Bitcoin and do this compounding, and you take the other part and you try and multiply that much more. You go for the 10x, you go for the 20x, you go for the 50x. And if you make returns on that and you keep the returns, then it just adds to your stack of Bitcoin. It does not have to be one or the other. It's the biggest psyop ever. That people think they need to hyper gamble their entire net worth to try and make it. Because people are trying to make it over a 1-year period and not thinking at all about a 10-year period. Think about both. Focus on making it for certain in the long term, and then focus on maximizing the conditions like we have now, where we probably have another 6 to 12 months of good conditions of bull market left. You can try and do both, but you should always, first and foremost, be thinking long term. Future you, if you listen to this, future you is going to thank you. The you of 10 years from now is going to look back and say, thank God I listened to that lesson. Thank God I actually started doing that. So, let's now take it back to Bitcoin. 30%, okay? 30% with no deposits, nothing else. That would be the 137, right? So 10K would grow to 137 over 10 years following the Bitcoin model. If you do the exact same thing though, we're adding in 500 a month and it's growing every year by 20%. You can have 650. And again, that's not including your trading. This requires no effort. This requires no brain cells. You can have a single digit room temperature IQ and still do this. You don't need to be smart. You don't need to have any excess knowledge other than what I just said. You just have to be making some money and putting some of that money into long-term approach every month. You don't even have to dollar cost average or follow any kind of process or any kind of system. well, you do kind of DCA. You just say, every month I get my money, I put some of that money into Bitcoin because I believe in Bitcoin over 10 years. And when Michael Saylor's the richest man in the world, I want to also be rich. And if you did that, then you would 65x your initial in 10 years by doing nothing. Well, technically it's a bit less because obviously you put some deposits in. But by doing literally nothing, no hard work, you can have a lot more money than anybody would have if they don't follow it. Now, how you take that and you build on that is that you are also focusing on trading, what you're learning here. So you're focusing on long-term trading. That's your 10 years with adding in some more money from your monthly savings or your monthly income. But if you also focus on trading, the only reason to trade or invest is that you outperform the index. So if you're a stock trader, the only reason somebody trades stocks and the target that every single hedge fund has is to outperform the benchmark, which is the S&P 500. So if a hedge fund does not make more than 9% annualized, they are not worth investing in. You might as well just put your money into a ETF of SPY. You might as well just put your money into the S&P 500 and just leave it, right? So if you're going to outperform by building and testing and developing your systems and your processes, you're aiming to increase this rate to not what people think, which is 10x money every year. In the next 12 months, could you take your trading portfolio and 10x it? Yes. But over the next 10 years, the goal is that throughout both bulls and bears, you have an average annualized growth, compound annual growth rate of, let's say, double, say 60%, okay? Which means with the trading you do, you outperform the average growth rate of Bitcoin because you are making money in the bull markets more than just the Bitcoin returns. So you're also getting into other assets that rise more. And most importantly, you're avoiding the majority of the major drawdowns. So you're not taking the 70% drawdown in a bear market. You're maybe taking 20 to 30% of that. You're not selling the absolute top. You're not buying the absolute bottom, but you're minimizing the overall. And just that alone, without making any extra money in a bull market, just avoiding the majority of the worst of a bear market can easily boost your compound annual growth rate to 60. Okay. So with what you learn in bootcamp, if you did that, this would be your 10-year plan. You'd have 3 million. By just the same 10K starting with just outperforming the standard Bitcoin, 30%, by learning how to trade and invest, by learning how to buy and sell at roughly the right times, and by topping up your portfolio, your balance, you can vastly outperform everything else by having a low time preference, focusing on the long term, and also not sacrificing anything. This is all the stuff you're going to be doing anyway. This is why you're here to learn. This is what you're learning. But you have to understand that you're not just learning how to trade. Even if you're a day trader, this is the same thing. A day trader who is focusing on making money on intraday trades is still a long-term investor. Because what you're trying to do is you're trying to grow your stack over time. You just choose to do it by taking short-term trades instead of long-term. But the goal of a day trader is what? To have more winning months than losing months, to make more on the winning months than they do on the losing months, and at the end of the year to see a high double or low triple digit return on the portfolio. So if you could make anywhere between 50 and 150% per year as an intraday trader or a multi-week swing trader or any type of trader, over the long term, you will massively outperform. Like insanely. This is only a 60% compounded rate. And you can see how much that grows. And then in the periods in between where there are opportunities to make a lot of money in a short space of time, you take a smaller percentage because that will end, and it will usually end with a bang. It will end fast with massive crashes. So you take a smaller percentage of your total stack and you play the higher risk but higher reward phases, and you're disciplined and diligent about taking your profit, which I'll talk about tomorrow on the second part. And you use that to increase your long-term stack. And the whole goal of all of this is to get money into assets that something is a bad investment, and also